mean, we're very lucky. We use a company called Evidence-Based Investments, who are not very far from you, I don't think. They're based in the West Midlands, and they provide some fantastic information on expected rates of future returns that are applicable to each portfolio. And what they do, they very helpfully talk about those numbers as figures in excess of inflation. So what that enables us to do is to have a look at our inflation rate. And if, for example, the figure I happen to know is that their portfolio is 60, which is very simply 60% growth assets, 40% defensive assets, is expected to yield a return, a total return of 3.63% per year. Okay. So if we add that to our inflation assumption of 3, that gives us 6.63. But we need to take into account total charges when we're working out what the assumption we're going to use would be. Now, I happen to know we charge 1% as a financial planning fee for our full service. And by the time we take into account the platform fee and a fund fee, we're getting up to around about 1.5 to 1.6% in total charges, OCF, the full compliant way of disclosing charges. So what we do is we deduct that from, say, the 6.63, and that gets us back to, quite conveniently in some respects, an inflation, a growth assumption of about 5% for a mid-range portfolio, a 60-40 type portfolio. Now, clearly, we wouldn't use that if it was a bond portfolio, and we wouldn't use it if it was a wholly sort of equity-based portfolio. But it's around that range. So EBI tell us what their expected rate of return is, which takes into account the different asset classes that are included in the portfolio, which includes things like emerging markets. So the sub-asset classes, not just equities and bonds. And we get that number and we use that. So again, we think, and again, looking at historical performance as well, we think that's reasoned because of the information that we have from EBI, and we think it's reasonable in the context of what's actually been achieved against a backdrop of inflation similar to what we have now. And at the end of the day, if you think about it logically, it's the real rate of return, the bit above inflation, that is the important thing. Because what history shows us is that gap, it's not totally constant, they're not locked together, but the gap between inflation and the asset class returns is remarkably stable. It moves around, but it is remarkably stable. And in terms of your wealth, it's that gap that's important. Am I getting richer or poorer by the 3 or 4%, whatever it might be, above inflation? And that's when you look at that in the software. I've done lots of tests on this to see what difference it makes. You can see, yeah, that's a solid way of doing it. The conversation I have around that really is that it's okay to hold cash. It depends on your financial position. Everyone needs cash, a contingency fund. And what I say is, look, the difference between the rate of return, the fluctuating rate of return that you might receive in a balanced portfolio and the return you're receiving in your bank. So I had a client the other week with over £1 million in a Barclays everyday saver, and she was getting 0.05%. But the difference between what you might expect with a balanced portfolio, let's say 5%, and the 0.05, that's the cost of keeping your money liquid. So the real question is, how much of that money, your wealth, do you need to keep liquid? What's reasonable in that context? How much of a contingency fund should you have? And again, that's a very unique perspective. People have a very personal view. Some people think, well, I'm never going to need more than 10,000 in cash. I've never had to write a check out for more than 10,000 that I wasn't expecting. Other people, it's 100,000. I've even got one guy, I promise you, it's £1 million. It's £1 million he keeps in cash. And when I've challenged him on it, he said, my father was made bankrupt when I was young, and I saw the impact that had on me and the family and him. And he said, it doesn't matter what happens with my business or my other investments, as long as I've got my £1 million in cash, that can never happen to my family. And needless to say, he's a very wealthy man anyway. It's pretty hard to argue with that kind of.
That's a fair point.
Okay.
No, absolutely.
Let's leave that. So it's a very personal thing.
Yeah, so we use, so the portfolios that we use for our clients are sort of strictly asset allocated. So, growth versus defensive assets. So those asset allocations really drive what we use in terms of growth rates. to get ourselves to a figure, we use the report that PwC, PricewaterhouseCoopers, did for the FCA, or they do periodically. The last one they did, I think, was 2017. They did one 5 years before that in 2012. And we look at what they are suggesting as potential growth rates for each of those asset classes, map that over to the assets within our portfolios, and come out with a figure at the end of it. Now, for the majority of our clients, you know, if they've been with us for any period of time, you know, they will have seen that their real life returns have been greater than those figures. But we are quite firm on the fact that, you know, that's great that that's happened in the past, but we're now looking forward from this point onwards. And we want to make sure that we're putting in a realistic and sort of conservative estimate of where we think things are going to go. And also make clients aware that this might change. You know, the world changes around us, and things may change over time. You know, the PwC report does take into account economic cycles and things like that. So when they redid it in 2017, most of the growth rates came down a little bit from where they had been before. And likewise, I'm guessing if they do another one next year, we'll see where things are at that point. But, you know, it's making clients aware that, you know, these things can change, but, you know, we have a sort of what we expect to be, which is not necessarily your real life experience, but we would rather you were expecting less than you achieved in real life than the other way around. So yeah, that's where we get it from. And, you know, so we feel quite comfortable that that's kind of an independent place to get it from, rather than a sort of, you know, see what we think is happening, or look at what other people are using. You know, if I want to sit there and say, this is why I'm using it for you, Mr. and Mrs. Client, I want to know that it's got a sort of sound backing.
We use we look at the MSCI World Index, averaged around about 9% a year. We deduct 1.5% for overall costs of running the portfolio. So for an equity portfolio, we'd assume a return of 7.5% a year. On the flip side, with our short-term fixed income, so the Barclays 1 to 5 year hedged index is probably done around about 2% on average a year. So we would again reduce that by 1.5%. So about 0.5% for a full short-term fixed index portfolio. And then we would blend those two returns together depending on what mix they had. So if they had 50-50, 50% of the risk going towards the 7%, 7.5%, and 50% of the risk going towards the 0.5%.
Okay, so if we go back to our risk profile, we use Phenometrica, and we use their mapping, and we also look at the asset allocation. So our portfolios are tailored to the asset allocation with Phenometrica, and we insource our investments. So we're able to do that and lay down the criteria for those portfolios. Then we've looked at 10-year historical figures, and we look at the growth rates that we've achieved and against composite benchmarks that we've set up against the portfolios. And generally, we look at a historical 10-year return, and then we look at the average recent realized return, and then we work out our own assumptive rate, which takes into account inflation, 3% inflation. So for risk group 4, for example, which is the middle of the road, it would be 6.2, but then we would take the fees from that, and it would work out about 5%, something like that. We keep a whole list of them. We've got the whole, which we review from time to time. So and so the growth rate will be whatever the client's risk profile is.
Okay, so we have growth rates of 3.5, 4.1, 4.45, 4.85, and 5.4, and they are mapped to the booster portfolios that we build and offer in-house. So we have what we call our risk mapping document. Starts off with risk profile outcomes. So what would this, if you just took it on a risk profile outcome and mapped it to a portfolio without any further conversations around what might be right, If it was just the mapping, where would they link to? And then the boost portfolios link to those outcomes. Clearly, there's then a conversation around their wider planning and if actually they should be taking more or less risk. That's a sort of a starting point. We then have, we work with Albion, who provide all the academic input for our portfolios, our investment philosophy. We then have our Boost core portfolios and our Boost ESG portfolios, which are aligned at the different stages of risk. They have expected growth rates for those portfolios based upon historical performance over the last 100 years of the asset classes, which is wonderful, but they're not figures you want to rely on for your financial plan. So we have expected asset growth rates based on the assets, and then we actually have then reduced figures that we use, which are those that I mentioned for our cash flow planning. So the highest we get to is 5.4, which is 2.4 above inflation. 2.4 real growth is a very low, very realistic growth figure. But where we're doing flatline projections, where it's not stochastic, we feel it does need to be a sensible growth figure. There's a danger with planning conservatively in this way, because if you're always conservative, if inflation's high and growth is low, you could end up saying to somebody they need to work for longer or they need to spend less than actually they could do, which is why getting all the real deep refinements around their expenditure, how things will change, making sure it's a really realistic plan, and then reviewing it regularly is really important. Because having that low figure, suddenly if you get a growth rate of 15% one year, well, suddenly that makes a huge difference. Equally, if you get a minus 15% year, that makes a huge difference. So instead of using a higher growth rate and then just trusting it and relying on it, it'll probably be accurate, we like to use something a bit more conservative, so our decision making along the journey is more sensible, but absolutely reviewing it. And all Boost clients have that review structure in place. We don't offer financial planning with no ongoing reviews. Something else might be interesting on that is, so we don't use different growth rates for tax-free investments and taxed investments for most cases. So if a client has got a pension, an ISA, and a general investment account, if their general investment account is £150,000, well, realistically, we're able to plan that so that there is no tax liability. We can use their various allowances, CGT exemptions, so that there isn't any difference in tax, therefore performance being lost. Where we've got clients where actually it's a £400,000, £500,000, £1 million general investment account taxed, in those cases we then use a slightly lower growth rate, and we actually split it between the capital growth and the dividends just to improve the tax computations in truth as well, just to give it that bit more accuracy. Not for all taxed accounts, only where it's actually going to create a tax, but that added bit of detail can make a surprising amount of difference. We've had clients who have not done that, and then we have done that, and even the difference in dividends and splitting out to dividends and capital instead of just assuming it's all capital growth over a long term makes quite a big difference in some cases.
Okay, client risk specific. Typically, we err on the side of caution. So we might say, 2% capital growth, 1% income, 2% capital growth, maybe 2% dividends or income. We tend to use the portfolio's target rate because they have target growth, some of the portfolios that we have. But we can play around with the rate stepper, and we also use a stochastic calculator where necessary, just to look at the impact of volatility. Okay.
Excellent. So when you say you are on the side of caution, so if the portfolios have projected growth rates, would you, how would you treat those growth rates when looking at building a cash flow?
Well, that's more, for us, that would be more a case of in the meeting, live and interactive with the client, let's just look at what we've assumed. We're planning prudently. And if you want to put in place the actual growth rate that the portfolio is targeting, let's just do that, and let's just see the difference in the draft maybe, and just see the difference in the two, because the time value of money is just extraordinary, as you can see. It's breathtaking. So the difference that makes. So we would tend to come back to, okay, so Mr. Client, your portfolio did this last year, aren't we clever? Great. But going forwards, we can't guarantee that. Let's go prudently. Let's just assume And usually we've got a whole, I mean, if you've got for new clients, you don't have the performance history, of course, but if you have, long-standing existing clients, and we're lucky that we do have a lot of clients that have been with us for years, we've got a performance history that shows the annual average rate of return net of fees now. So we're able to say, look, this is what it's achieved. This is more than it should have achieved, or this is less, or this is on track. So let's just assume, having looked at your risk questionnaire, is this realistic? We also use like Finametrica for they have some really good statistics in there to be able to show what are good asset allocations that you should have in place, which drives returns most of the time.
Okay, again, we have the conversation with the client, and in most cases, the client always say, "What do you think?" By this point, we would have typically received information from their providers if they've got existing plans or current plans that we're looking after, so we would know the asset mix. Most growth rates are between 4 and 6%. We're quite conservative on that. We don't want to overshoot. We don't want to make it so bad that it doesn't look good at all. But those can be adjusted annually as well. If the client has strong views, but we tend to lean towards arguing, say 5% on most things. That's not including cash and overdraft. We'll come to that in a second.